Well, hello, everyone. Welcome to Friday the 13th, and welcome to this advanced options strategy class. Mr. Brent Moores is in Houston, and the folks in Houston are going to be joining us in a few minutes. So feel free to blow up the chat with, greeting them and wishing them well when they do join us. But I am filling in for Brent today. And, as I looked at, the cornucopia of trading strategies available to talk about, we could have talked about, jade lizards or butterflies or double diagonals or, and yeah, I'm not just making this stuff up. These are all, legit trading strategies. But in looking at our different option choices, we want to look at what's going on in the market. And although I'll go out and have a quick look at the four indices, I mean, the market has been bullish, So I thought we'd talk about covered strangles today. And again, I've talked about covered strangles before. It is a very bullish strategy on steroids, you might say. And if it's not a strategy you're familiar with, I'm not going to assume that you understand anything about it. We're going to kind of go over the basics of what it is, and then we're going to look at 3 different example trades, just depending on how quickly we go through it and how many questions there are. Okay? So if that sounds good to you, sounds good to me, that's what we're going to talk about today. I want to thank all of you who have not only joined us, but who helped bring the chat to life. We've got James riding shotgun in the chat with us, Mr. James Boyd. And I know that some of the Boydistas are here along with him. So if you've got questions, he understands this strategy and anything else you might want to throw at him. Between him and I, we should be able to answer your questions. If you're watching this in the chat and you in the archives, you can type in your questions down below. So just know that everything that we do in this class is for example purposes only. We use the Paper Money software application on the Thinkorswim desktop platform, which is a brilliant place to learn. Now, one of the differences between Paper Money and a live account is that in Paper Money, short options will never be assigned early. We are talking about a strategy that has 2 short option components to it. But in a live account, those short options can be assigned at any time from the time you place the trade up until expiration. So it's important that we understand what to do and discuss what to do, if that were to happen, and we will talk about that. Know that options carry a high level of risk and aren't suitable for all investors, and you have to apply for option trading privileges with Schwab. Okay? So that's that. And even though, even if we put a stop order in place, there isn't a guarantee that that stop is going to be executed at the exact price we requested. If a stock were to gap up or down, we could end up out at a different price. Okay, so Andrew, if you are new to this, welcome aboard. I found this education back in 2011, and it has been quite the wild ride for me. I've enjoyed every moment of it. I actually joined as a coach in 2016. So we're going to go out and have a quick peek at what's going on in the markets, and then we're going to look at that one particular option strategy today, covered strangles, and we're going to play some examples and kind of talk through it. Okay, so let me bring up the platform. So we've got somebody tuning in from Houston, so it's good to see you guys on board. I haven't seen Mr. James Boyd in yet. So I'll wait for him and then we can officially welcome everybody. But when we look at the S&P 500, it hit a new all-time high within the last week. And like I said in my earlier class, because somebody had brought up one of my favorite quarterbacks who now is with the Jacksonville Jaguars, you don't have to be a professional football player to be able to throw a ball and hit the all-time high from here. Okay, so that's our S&P 500, up almost 27% year to date. If we look at the NASDAQ, NASDAQ hitting a new all-time high today, up 29%. On average, this index is usually, over the last 30 years through all the ups and downs, been up about 13% on average. So 29% is absolutely crushing it. So that's two for the bulls. When we look at the Dow, and the Dow's been pulling back for the last several days. So you might say, would you still call this bullish? Well, yeah, I would. And why is that? Well, because, and it depends on what time frame you're looking at, but when we look at year to date, the fact that it's up 16%, when we look at the fact that it hit a new all-time high, this index, with, at the beginning of December, and then, we look at this trend, like it's flirting with the 30-day moving average. And we've had a very short-term pullback, but I don't think it means that the trend has necessarily changed. Now, the trend could still change. There's no doubt about that. Okay. I'm just scrolling up to just make sure I'm not missing any questions and to see we've got Will, coming in from the Houston market event. Like, so glad that you were there. I wish I was there too, able to meet you, but then I couldn't be here doing this. So we got to pick our poisons, right? And the Russell, this is the one that is the least bullish, I would say, although it's up 15.5% year to date. It's now crossed that 30-day moving average. Now, it's crossed the 30-day moving average, back here, and that was for a couple of weeks. It was on, the bearish side of the line. It dropped down briefly here, but it didn't stay. So just because it's down for one day, again, doesn't mean that this is a trend reversal. Okay, so there we go. It, generally speaking, has been uptrending this year. And then if we look at our volatility index, it's at the low end of the range. It's under 15. And it hasn't spent much time there since the beginning of the summer. Yeah. Okay, so there we go. And then when we look at which sectors have been strongest, if we come down here, and I've done a mini session on how to customize this if you aren't familiar with how to customize a watch list, but we've got consumer discretionary over the last 3 months leading the pack, followed by communications, financials, and technology. And so, these have been our areas of strength. And you'll see that, like if technology in fourth place, and yet hitting this is over the last 3 months, but up 38% year to date. So beating all of the major indices and hitting a new all-time high today. So pretty hard to argue that that's anything other than bullish. Financials, hit a new all-time high back here at the end of November, but so far in December have been kind of pulling back and have come all the way back to the 30-day moving average. So, it's not like the bears have come out of hibernation, but we have seen a bit of a pullback here. And then communications hit a new all-time high this week. How about consumer discretionary? Yeah. Again, Trevor Lawrence didn't have no trouble hitting that all-time high, which, we hit yesterday. And here we have Houston on board. So, I wouldn't say Houston, we have a problem. Houston, we have two great events happening, one virtually, and then one happening in Houston with Riceburg and Entourage and Will W. and the rest of the gang. Like I said, it's a little bittersweet that I'm not joining you, but I know that you're in fantastic hands with Ben Watson and Brent Moores and the rest of the team. They're great guys, and I hope you guys seek out the opportunity to talk to each and every one of them while you're there. So I think it's so impressive that you are all attending this last in-person event of the year. So hello and welcome. Okay, so we are going to talk about covered strangles here. Oh, Donna Parts is Donna. Hi, Donna. She's in Houston with Ben as well. That's so fantastic. I believe Donna lives in Texas, but you can live in Texas and it's still a long drive to get to Houston, isn't it? So however you got there, I appreciate everyone who's made that effort to be there. And then everybody who could be doing other things today, who's made the effort to be on a webcast like this, your future self and your family, I'm sure, will appreciate it. So let's go now and look at Reddit. So we did a couple of trades in the trading a smaller account class on Reddit. We had a target of 158 and it has hit that. I'm going to take the target bit off here, but I'm going to leave that line. And the reason I'm leaving the line is we're going to talk about covered strangles, as I mentioned. And what is a covered strangle? Well, it's a very bullish strategy. Okay, gotcha. And what that strategy involves is buying 100 shares of stock. So we are going to buy some stock. We're going to buy 100 shares. And, you know, I have a habit of not erasing. We have $500,000, like half of our account is sitting here in cash. So we're looking to buy stock. And this is not a long-term trading strategy. It's kind of a short-term dating strategy, if you will, because we're going to buy the stock. We are going to sell a call above it. So that's like a buy right covered call, right? Right. And we talk about that and getting started with options. So we're selling a call, we're selling a covered call. And then we're going to come down here and say, you know what? I have this is over $1 million account. So, you know, this is, if we buy the stock today, that's a $16,000 position. You know, we can have up to a $90,000 position, or, you know, if we had a 5% account position size, that would be about 60,000. So we could afford to not only buy 100 shares, but we could also sell a put here, maybe around that 158 line, and say, hey, it's trading at 168 right now, but if it came down a little bit, I'd be willing to buy another 100 shares, because when I sell a put, what am I agreeing to do? I'm agreeing to buy additional shares at that strike. And so what is the goal? Well, the goal is to collect the premium for selling the put, to buy the stock, and then to sell the call. And you can look at this different ways, but we're going to structure this in a way that our goal is ultimately to be called out. We're bullish on the stock. And if in fact, you know, we sell the 180 and it goes up to 200 and we get called out, we'll have had this conversation with ourselves and agreed that, you know, if we get called out, what would happen with this put that we sold? Well, it would expire, it would become worth less and ultimately worthless. It would expire. If we're called out, we no longer own the stock, but the plan is to have made enough of a profit that we would be happy with the result. Now, what else could happen? Well, it could happen that it comes up, and let's say we've sold this 180 strike and it's at 168. Maybe it ends up at 178. So if it ends up, you know, above where we bought it, this put, what would happen to the put? Well, that would still become worth less and ultimately would expire worthless. And it doesn't mean that we're going to wait for it to expire worthless. We might buy it back when we've got 50 or 70 or 90% of our gain. It depends on, you know, what's happening with the stock and what your trading plan suggests. And then this call, if it's not above 180, this call would end up expiring worthless. So we'd have made money here, and the stock's gone up a little bit, but we'd have made money here. Then what might we do? Well, we could just liquidate the position, or we could say, you know what? This worked out nicely. I'm going to wash, rinse, repeat. You know, I'm going to do this again. Somebody's saying, you know, could we do this with a long call instead of with the shares? Yeah, we could. But then it wouldn't be a covered strangle. Well, I guess maybe it's a long call strangle. But, you know, with this particular trading strategy, we're doing it with the stock. Now, what is door number 3? I'm going to go to a red marker here, because this is if things do not go according to plan. What if the stock comes down and it goes below our short strike? We could be assigned, or the stock could be put to us. So all of a sudden, we're going to own shares of a stock that's probably trading below what we had to pay for it. This call would become worth less and ultimately worthless, but the stock is going to go down in value also. And so in order to define our risk, and we might say on $1 million account, we'd like to limit our risk to maybe 5,000, half of 1% or 6,000. So we might say, hey, if this goes, more than a certain percentage below what we see as a support level, we'd like to just pack it all in. And others might not want to put a stop on it. They might just choose to monitor it, the position. And you can do it however you like. Okay. Okay. Are there any questions about the strategy? Okay. Okay. Either everybody's totally confused or I did a fantastic job of describing it all to you. So let's look at Reddit as our first example. And you might say, well, why did you choose Reddit? Well, first of all, this is a stock, we don't even have a year-to-date number for it. And why is that? Because it usually shows up right here. But if I change my drawing tool, this just IPO'd this year in June. So if we kind of come from where it IPO'd up to where it is today. Oh, doesn't want to show me. Yeah, we're up 155% in 6 months on this thing, in less than 6 months. How did I end up with so many trend lines? I want to remove these. Okay, so I can do this afterwards. But so, this has been really bullish. So could we come out here and maybe sell something around this 180, sell a call, buy 100 shares of stock, or, we could even make it 175. So let's go and look at this. So if we come to the trade tab, does this trade more than 1 million shares a day? Yes. If we come out and we look at this 180, let's come back to 10 here. If we look at the 180, this is, we have 577 contracts, so we've got lots of volume here. We've got a bid-ask spread that's about $1 apart. So that's kind of at the top end of our 10% range, but this is a volatile stock. And so why did I pick a volatile stock? Well, I picked a volatile stock because the premiums tend to be higher, but then there's more risk. And then where might we want to put, sell our put? Well, we might say, hey, could we sell maybe this 155, something below where we think it'll go? And it's been tracking off this 10-day moving average and not just for a minute, like since September. Like that is bullish with a capital B. In fact, let's just capitalize the whole word. Okay, this is a covered strangle. JW. Somebody's asking what this strategy is. It's a covered strangle because we're kind of putting trades on both sides of it. Okay, so let's come out and say, okay, we are looking to buy shares, sell the 180. So in Thinkorswim terms, we call that buying covered stock. So what's the most we can make? And this is before we've added the short put. Well, if this is at, call it 159, and the most we can make is 180, were we to be called out? If I take 180 minus 159, that's a $21 gain on a $159 investment. I'm rounding up just to make it easier. That's a 13% gain. So you're saying, well, what if it goes through my strike and I could have made more? Well, let's not be greedy. I'm thinking 13% for a trade we could be in for 35 days, not so shabby. And then if on top of that, we come out here to this 155 strike and we sell the 155 put. Oh, sorry, I have to change this. First triggers, it could be first triggers all or first triggers sequence. In other words, if the first thing happens, then do the next thing. And the next thing is that we want to sell this 155 put. Now, what does that mean? It means we're agreeing to buy another 100 shares at 155 at any time between now and January 17th. But what does that potentially do? It adds another potential of $7 profit to this trade. And so now, we have the opportunity on a net $151 investment to make up to $28 divided by, call it 152. Now that's an 18.4% gain potentially. And so if we look at this and say, what would be ideal would be if we were called out. And so we're going to go ahead, we're going to hit confirm and send. So we're bullish, right? Right. We want to buy 100 shares of Reddit at the current price, $169.36. We want to sell the January 17th 180 call. And then we also want to sell the January 17th 155 put. If this whole shebang went to zero, we'd be out 30,000. But what we're going to do is we're going to put in an alert. Just in case, we take our eye off the ball. Sorry, I do have covered strangles in here. There we go. Fire in the hole. And if I get to fill in for Brent again, we'll go back and review these. So the reason Chris is saying, are you targeting a higher delta or are we offsetting the cost of the shares? What we're attempting to do here is create a relatively short-term strategy. The goal is to be out of this trade in 35 days or less. And this is our covered strangle. And this is the short put at 155. So our expectation here is that it's going to stay above 155, although we've sold a put and we're bullish on the stock overall. So if it came down and we ended up picking up 100 shares, if it went down to say 150, would we be devastated? Maybe not. We'd be okay with owning that extra 100 shares. But the idea is that we're bullish and we're saying, we don't think it's going to come back to 155. So we're going to sell a put. We're also going to sell this call. This is the second part of our covered strangle at 180 with the goal of being called out. And this is our, covered call or our buy right covered call. And we're buying it on this day. So if you want to go, when you bring up this chart, you'll see, this is when we got in. And it's our expectation that this will, continue to go up. And the ideal scenario for us might be for us to be called out. We'd be totally okay with being called out. Now, if we aren't called out and it finishes at, it closes at 175 or 178, this could expire worthless, or we might have bought this back, and then we might just do another trade where we sell another put and sell another covered call. And we'll discuss that in upcoming classes. In January, I'm going to teach a class called, I'm teaching two new classes. One is trading after hours. This is the kind of trade we could put on after hours. And another one called, trading price patterns. And we're going to look at both short-term trading strategy and longer-term trading strategies. So we are going to put in, if it gaps down, we could end up losing. There's no doubt about it. But we are going to put in an alert here that just says, hey, if this goes below 155, covered strangle, do we exit the position? Because our expectation is that it will stay above. So this will give us a notice and say, hey, yeah. Yeah, and we're okay with being called out. The idea is we're okay with being called out. If we aren't okay with being called out, then we wouldn't sell the covered call. And what are the probabilities? Well, right now, the probability of this being in the money come January 17th, it's 35.8%. So, we've got a 64% chance of it being below 180 come January, but you've got a 76% chance that it will go up and at least kiss it. Or if it goes through, if we were called out, would we be sad? Well, no, we'd have our max gain on that part of the trade, prior to expiration. So that's not something to be sad about. And chances are this call would be worth less, and we might want to close out that call by buying it back also. Okay. I like your questions. Okay. Okay. So let's look at another one. How about let's look at Tesla. Tesla seems to be the talk of the town lately. It has gone up like to beat the band since the last earnings, right? And also since the election. So, when we look at this, because this thing, Tesla is a pretty volatile stock also, which is why we're looking at it, up 80% in the last 29 trading days. So you might say hey, have we missed it? Well, what are the pundits saying about this? Well, if we, bring up the live news, and actually, I think this is one where, it was interesting. You have to go back kind of a ways, but, valuation tops 1.3 trillion. But you can go back and have a look and just see what different companies, the different analysts are thinking about this stock. You can also go to the Analyze tab, and there are a number of reports that you can access as well. But if we look at this and we say, well, it's hitting a new all-time high today. It's yeah, well, don't you wish we'd bought it a year ago? Yeah, well, I wish I'd planted a tree 20 years ago too, but we are where we are today. But what we've seen is the last two pullbacks have lasted how long? One day. And so if we look at this and we say, okay, this is an expensive stock, but we have a big portfolio here. And if you said, well, if we have 1.3 million and you could have up to say a 7% position size, 1,302,000 times 0.07, that's 91,000. So, we're paying 43,000 for 100 shares at the current price. And then where might we sell? Now, if you want to be called out, it depends on if you want to be called out or not. Could we sell the 450? Yeah, we could. And if we're looking at where to come down to, could we sell the 360? That's why I had so many strikes, because I was looking for the 360. So we could come up here and say, we want something maybe around this 450 level. What are our odds of being called out at the 450 level? Well, given that this stock in an average day moves about, over the last 14 days, has moved about $17 from top to bottom in a day, it could be there by next week. And again, what if we're called out? Well, yippee skippy. We've just met our max gain on the buy right covered call part of the trade faster. What's to say, well, let's go up to 460 or 470. Well, let's go out and look. So if we come out here to January and we look at the 450, they're going to pay us $28. We've got 18,000 contracts. This is a $430 stock, and it's traded for 65 million shares today. Holy smokes, Batman. And we've got a 40% chance of it being above, like a 39.5% chance. These are fluid numbers, they're changing all the time. But with where it's currently sitting, they're saying, the probability is 39% of it being in the money come January 17th, and 83% probability that it will at least kiss it or go above. And, maybe we should sell the 155. You can sell whatever you want. But this is just an example, right? So if we're looking at, again, in Thinkorswim vernacular, that's buying covered stock. So the most we can make, I'm putting air quotes around that, my friends. The most we can make is $45 a share. Well, I'm not a mathematical genius, but that's over 10%, my friends. And we haven't even added the short put yet. And this is where I had to go to more strikes. So if we come out here to 40 and we say, okay, so if I add the 360, that's only $6.90. Well, but you've got a delta of 14. So you've only got a 19% chance of that being in the money, only a 37% chance of it kissing it. So you might say, well, why don't you go up higher if you're okay with owning more shares? Well, you could. But I kind of looked at it, it's like, what's the latest support level? Now, some would say, like, Barb, you're going too far back. Like, I consider this to be this support level. You can consider it to be whatever you want. Like, I'm picking 360. But you can pick whatever you want. Because if it came back down here, I'd be okay with buying another 100 shares. In this, theoretically. I'm not saying that this is, a recommendation. None of what we're talking about is a recommendation. These are all just examples. But if you said, like, hey, were this to come back, I might be okay with adding another 100 shares. If you're saying, oh, I'm going to be hyperventilating if it comes back for a couple of weeks and it's put to me and I end up now, having 200 shares, that I paid over $400 a share for. Yeah. 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 Even with Elon's $56 billion a year salary, I'm sure he's getting by somehow. Okay. So let's go in and set this one up. So we've got this piece on here. Now, if we come to this 360 and we're going to sell, and again, I always forget this, I've got to change this first, so it can be first triggers all or first triggers sequence. We want to just sell a single contract. Okay, so if we look at this and we say, okay, to get in, if we call that $7, okay, and this 404, that'd be 397. And what's the most we can make is 450. So we could make $53 a share on an investment of $397 all told. Kind of, sort of. That's about a 13% return. If it worked out and you were called out, and we've already gone over the variations on the theme of we could end up losing. So where would we put our stop? We might say, hey, if this goes below that 160, we need to look at this again. Okay. So we're going to go ahead, put this one in, covered strangles, fire in the hall. And again, 75,000 potential position, right? If it were put to us and Tesla went to zero in the next 35 days. Now, the probability of that, not high. Like if we look at this, there's only a 12% chance of this stock getting down to 335. If we come to 60 strikes, there's only a 6% chance of it going down as low as 300, let alone zero. And I'm not saying, that, but technically that is what's possible. Okay. Okay, so Chris is asking a question. Just let me read this out. So the bottom line for a covered strangle is we're hoping to make the price per share plus a little time premium at the risk of being assigned, and the and the loss per share on a large price drop. Correct. So what we're looking to do ultimately, if we're looking at this one, and you might say, well, my ultimate goal here, if this is our covered strangle, this is the top part of it. Our goal is to be called out. And this is January 17th, I think, is our date. Our goal is to be called out. If we're not called out, our second best situation would be, for it to close close to our covered call strike. And then we've got this 360 strike here. I'm going to change this to 360. This is the other piece of our covered strangle. We know that, worst case is we could be assigned. This is our short put, a short put piece. So ideally, we want it to stay above. Now, if it comes down and it ends up closing, say Tesla comes down and it closes close to expiration or at expiration at 365, this would likely still expire worthless. If it closed above 360, correct? This would expire worthless and we'd still own the stock. But we paid $430 for the stock. So if we come and we look at this one has filled, we'd have been paid $28 for the call and $7 for the put. So we'd have $35 of easing of the pain, but we'd still be down on the trade. Okay. So this can help, ease some of the pain if the stock pulls back, but it's not going to eradicate the potential loss. Now, Reddit, we're not in yet. So if we come and we look at our working orders, we go by time placed. Here's our trade on Reddit. And it's saying, well, we were willing to pay $158.79. They now want $159.50. Oh, you drive a hard bargain? Okay, that's what you want. Let's make it a round number. Let's go to 160 so we can get filled. We'll put that in our covered strangle bucket. Yeah, there we go. So we got filled. So the same thing goes with Reddit, right? So our covered calls, if we're wrong on direction or wrong on the shorter term, but it is a very bullish strategy. Yeah. Okay, so if we want it, do you guys want to do a third example or you want to wrap up? If we wanted to do a third example, we could look at Marvel. And Marvel gapped up today. And so, again, this is a stock, it's more than doubled since its low in the last 6 months. Back here on August 5th of 53, it's come up here to 121. And again, this is hitting a high. So you might say, really? Is this really what we want to be doing today? But, we could take a look at this. And even if we went for the 125 or the 130, and then where would we want to sell our put? Maybe here around the 105. If it came back down here around this 105, could we get enough premium for that to be worth our while? Well, let's have a look. And we aren't going to need 60 strikes, I don't think. So if we come out here and we say, well, we were looking at the 120, we're looking at the maybe 125 or the 130. And then the 105 on the put side. Got a great memory, but it's short. So let's say we do this. If we want to be called out, this strike here has a higher probability, 38%, 77% chance of it at least kissing. And it is hitting a new all-time high today. So if it pulls back, what could we do? If it pulls back and then looks like it's bouncing, we could buy the call back and then sell another one when it gets back up here. But this would give us a higher probability. Now, here we'd receive less of a premium, but lower probability of being called out. So it depends on what, are you looking, to put yourself more in the middle of the road where it's more likely, to be called out. And then if we come down here to the 105, we're only getting 91 cents. And, that may seem like chump change compared to the other stocks that we looked at, but this one is a little less volatile for starters, and it costs a quarter the price. Yeah, so we're going to just go in and put this one in quickly. So the 125, we're looking to buy covered stock, and then we're going to make this a single order for trigger sequence, and we're going to sell a single. And so, the most we can make is that 115 to 125, about $10 a share. So that's just shy of 10%. Yeah. And we're going to put this one in as well, our covered strangle bucket. And then we're going to come back and we're going to put in an alert, and we're going to say, why did I sell the Marvel? Oh, because I was selling the call. If this goes below that 106, we want to manage our covered strangle. Okay, now we just have a couple of minutes. Our time, it comes and it goes so very fast. But I wanted to point out, if you're not following James and I on X, man, you are missing out. So I encourage you to do so. And one of the things that I posted Friday the 13th, let me know what group you're in. But I posted these new classes that are coming. So we have one on swing trading, trading index options, which I think will be an exciting class, trading price patterns, which yours truly will be teaching, and after hours trading, which I'll be teaching also. And you can go to Schwab Coaching, Schwab Coaching, the live webcasts and virtual workshops. So just to look at the January schedule. My schedule is changing pretty dramatically come January. I'm still teaching trading a smaller account Mondays and Fridays. I'm doing a trade with Cameron May. He's going to take over getting started with options. I'm going to take over getting started with technical analysis. And then I'm adding these 2 new classes to my roster. So I will be teaching every day. And so will James. And so if you want to see these, again, if you go to Schwab Coaching, and if you're saying like, oh my word, I am such a huge fan of James Boyd, come January, I want to be sure that I don't miss anything, you can click here from December to January, and then you can just scroll down and say, I'm a confirmed Boydista. I want to see all the classes that James is teaching. So Mondays, trading with technical indicators, Investors Masters series, trading growth and value, trading the trend, and then Trader Talks. And so he's, teaching every day, and you can sort this however you like. Okay, but I just wanted to make you aware of that. So as we wrap, I'd like to ask a favor of you. If you would please hit the like button. It helps move this up in the algorithm so more people can find this content. It also lets James and I know that you found this class today worthwhile. So do me a solid, hit the like button. Not a recommendation to go to any of James'. No, I am going to recommend that you go to James' classes. I think he's fabulous. So yeah, that is a recommendation. You can check them out, and then you can decide for yourself if you want to come back. So there you have it on that one. Hit the like button, subscribe to the channel, follow us in the land of X. That's Barb Armstrong CS and James Boyd CS. And then one of the questions or comments that often comes up is, would you show me what you did today just at the end of the class? So here's what we did. We placed 3 covered strangle trades. We did one on Tesla. We did one on Reddit. Oh, the short put hasn't filled on Reddit, so I'll have to go and look at that. and then one on Marvel. And should we get to meet again, we'll review these 3 trades, and I'll look forward to that. So my friends, get out there, have a fantastic rest of your day. Yeah, get out and hug someone you love, and I will see you on Monday for Trading a Smaller Account. Take care, everyone. Thanks to James and the guys behind the scenes for helping bring this webcast to life. Bye for now.